Stephen Nathan from 10X Investments, my guest this evening on the show. We're talking about indexing. Let's come back to it now again. So you've got all of these. What's confusing me here, Stephen, for me, is I can understand where you say, oh, you got Satrix 40. Those are the top 40 companies on the exchange. You've got the All Share Index. You've got all these different. So you could go into resources if you wanted to, or you could go into banking, finance, but there are so many of them. How do you make a choice?
Well, the choice really is made up front, where the investor should say, or someone acting in their interest should say, what's the right percentage, the right weighting in my portfolio that I should have in the stock market? That's the most important decision. So let's say you say it's 50% should be in the stock market. So you say, okay, 50% I want to have exposed to the stock market. Then what you should do is own the stock market. Don't try and pick and choose. Because what does the stock market represent? It's corporate South Africa. So over time, corporate South Africa tends to grow at about 7% real, the return you get out of the stock market, 7% above inflation. So you want to be an owner. You want to be an owner. Which companies are going to do well? Well, nobody really knows. No one knows whether the mining is going to do better than the banking, than the retail. And at different cycles, some of them are going to do better than others, and some are going to fall away, and some are going to shoot the lights out. But nobody knows that in advance, despite an army of people trying to do that. So it's a mug's game. Don't play that game. You don't have to play that game. You can try, but the results show that 90% of those actively managed funds perform worse than the market. So in Bogle, Bogle says, buy the haystack, don't buy the needle. What's the haystack? It's the equity market. Be as broadly diversified as possible. Don't look for the one sector or the one share that's going to shoot the lights out. You can do better. It's possible, but it's not probable.
Okay. Now, how do you guys then fit into this? What do you do?
Okay, so we focused on the retirement funds because it's the largest pool of savings in the economy. It's about 1.5 trillion rand. It's the biggest pool. So we think it's the most important savings to manage correctly. Okay. And what we do is we structure products. We have products. In fact, we don't structure many products. We've got one retirement plan. And we invest companies and individuals, so it's a pension fund, provident fund, preservation funds, retirement annuities, and we take each person and we invest them based upon how many years they've got to retirement. So that's the most important decision, is how much risk should you have? Should you have 50% equity? If you're close to retirement, you shouldn't. You should have less than that because it's too volatile. The risk is too large. But if you're younger, if you say 25, you should have more than 50%. So that's what we do. We invest everybody based upon how many years they've got until retirement. We don't ask them how they feel about the markets and how much experience they've had, because that's not a proven way to have investment success. So we get that asset allocation right, and then we index it. We implement that at the lowest cost. So we buy the haystack. We don't try and be smart. We don't try and predict oil prices. Get the market return at the lowest possible cost. And by so doing, you are likely to earn a higher return than the active managed funds, and after paying broker fees and investment management fees and performance fees and all those other add-ons. And that's it. So we invest everyone individually, index fund, the risk changes as you approach retirement, and then it's full transparency. So the big issue in this industry is how am I performing, what are my fees, how much am I likely to have at retirement, all of that. It's very simple, completely transparent. It's on the website, so you can go 24/7 and access that. And then it's about keeping fees to the bare minimum.
So you would then go, are you working mainly with companies or with individuals?
We started off in companies. So for the last few years, we've only been dealing with companies. We don't use intermediaries. And that's kind of a big negative from a company perspective. So we don't have people walking the pavements, peddling our product, because we don't believe it's in the investor's interest. It's another cost to pay. Very often it's a high cost, and very often you're going to be steered in a suboptimal direction. So we've only dealt with companies, but just this year we've launched a retirement annuity where we do deal with individuals, and we also deal with individuals in preservation funds. But our whole approach is deal directly, give you all the information to invest yourself.
So you ideally would walk into a company and take over their retirement fund, and then look at the individuals within that company and say, where should this person be in a retirement investment timeline? Or I don't know what words to use.
That's right.
Here.
No, that's correct. That's correct. So we take. You're exactly right. It's all about.
So
individuals.
you've got a guy who's a junior salesman, and he's 26 years old. What he should be invested in is very different to the CFO who is 52 years old, because of where he is in that retirement life plan.
That's exactly right. So companies made up of individuals, and we look at the individuals because there's no one guaranteeing a pension. Those days are over. So the individual employee takes the risk and rewards. So it's exactly right. We match each person to a risk-appropriate portfolio. So we maximize their return, but we protect their capital as they approaching retirement.
Okay, now you come back constantly to this thing about costs. How then do you keep your costs lower, or claim to keep your costs lower, because I've still got to see these numbers, than other people? How do you do that?
So the first thing is we don't use brokers. So immediately by eliminating brokers, you're taking a large chunk of the fee away. It's quite incredible how much people pay to their advisor. Often you pay more to the broker than you do to the investment manager. Most people don't know that. So that's a big cost. They're the gatekeeper. They own the client. I mean, it's one thing I learned as a research analyst. You go and ask a life company, who's your client? Is it Jeremy? Not Jeremy. I don't know who Jeremy is. It's the broker. So their client is the broker. They've got to fight for shelf space with the broker, and they do that by incentivize them in various ways. So we eliminate the broker. The second thing we do is we eliminate the active manager. So you don't have to pay 1.5% to 2% to have your money managed. You don't have to pay performance fees. We're eliminating that. You're getting the market return. And as I said earlier, the reason we eliminate it is that most of those funds, not all, but most, do worse than the market. So we give you the market at a lower cost. And then our whole business is far more simplified. Companies offer 300 different investment choices. We don't offer any investment choices. We say we have a solution. You mentioned the doctor earlier. We're the experts. We've done the work. We've given you something that's risk appropriate for you. Here's the solution. And that's much lower cost to administer than obviously 300 different investments.
Okay, now then how do I, because this is an immeasurable, and it's come up so many times on the show. How do I know where I stand right now? Because quite honestly, I don't. I know that I've got retirement annuities in place. I know I've got cash in the bank. I know I've got property, but I do not know. If you ask me for numbers, I could say I've got X amount in property, and I've got X amount in equities, and I've got, no, actually I don't even know how much I've got in equities, because I don't actually know where the money that I have invested is. I don't know if it's in equities or what percentage is in equities and what percentage is in bonds and cash. So it's frustrating. It really is. How do you get to an assessment here?
Okay, so there's probably two things you need to do. And the first is take it seriously. So let's say this is serious. When I get to 65, it's the difference between having a pleasant retirement versus kind of scrounging around.
Yeah.
So it's serious. So with that mindset in place, set a higher standard for yourself and for your advisor or your product provider, whoever that might be. So what does a higher standard mean? Get a little bit educated. You've got that book. There's some simple principles. In investing, there's simple principles and thousands of techniques. Ignore the techniques, look at the principles. So just get a basic understanding of investing. It's not that hard. There's some very simple books out there to do it. So set a higher standard for yourself so you can actually ask the right questions. And then ask of your product provider or your advisor, ask them, where's my money sitting? I don't care that it's in some fancy name, Global Titan, Entrepreneurial, Momentum, Play. Where is my money sitting? So ignore the marketing side. Say, I want to list on a piece of paper, I want all my investments, I want to know where my money is sitting and the fees that I'm paying. And once you can just cut through all the noise and the marketing, it's a very simple exercise. It's a very simple exercise, and you'll know my money's sitting over here. It looks more or less risk appropriate. You've done a bit of homework. Just a good rule, once again, Bogle uses is the low risk portion in your portfolio should equal your age, just as a rough rule. So he says, if I'm 30, then I should have 30% of my portfolio in low risk assets, in bonds, and 70% in equities. If I'm 70, then I should have 70% in bonds and 30% in equity. So a rough rule. Okay. So apply those kind of simple principles and have a look at your portfolio. Does it look more or less correct. Challenge your financial advisor. They may or may not even know themselves what it should be. Get costs, and you can make a realistic assessment. And if you're paying anything more than 1.5% in total fees, then you're on the wrong side of the game.
Okay, so there's one of the rules that we've learned. Okay, 1.5% is your top end that you should be accepting.
Yeah, we wouldn't charge as much as that, but no one should accept above 1.5%.
Okay, and the other one that I like is the thing about your age, because it gives you some sort of measurable. And also, yeah, the thing about finding out where your money is, because as I say, I don't know. I mean, I know I'm now 47 years old, so I should have about 50, let's say 50% of my stuff in low risk give me
assets, investments.
Assets, right, thank you. Sure, yeah, I'm getting a headache. But I don't know that I have, so I need to actually sit down and pull out all of my policies and say to the providers, where are these things invested? And what are my fees? Are they going to tell me my fees?
They should. They should.
Are they not under FICA or something? Isn't there a rule that they have to?
Well, they are obliged at the point of sale to give an estimation of what your fees are.
Point of sale for me was years ago, and some of these things.
Bizarrely enough, there's no requirement. There's no requirement to disclose total fees.
Really?
It's amazing. Even the large pension funds, the return you get, your investment return is net of fees. So you don't see my gross return, all the fees I'm paying. You just see a net return. So there's no requirement. 10X, we're one of the only company that we're aware of in South Africa that actually shows you the gross, your fees, and the net return.
Stephen, thank you very much. It's been very enlightening. It's also made me very, very scared, but also made me very determined. Thank you for coming to the studio and joining us this evening.